Most people won't realize a global debt crisis is heating up until it shows up in their daily life as higher rates, weaker purchasing power, and markets that suddenly stop acting normal. But the bond market usually sees it first. And when the bond market starts to strain, gold and silver don't always move immediately. They move next. The question is, will you recognize the signs before the move becomes obvious to everyone else? If you want clear, story-style market breakdowns in simple English, hit like and subscribe right now. I focus on what actually matters for a U.S. audience, how the big macro shifts can impact stocks, cash, inflation, and yes, gold and silver, without the confusing Wall Street talk. Subscribing also helps you catch the next update while this story is still developing. Now let's talk about what global debt crisis really means, because people hear that phrase and imagine one dramatic headline. In real life, debt crises usually build quietly, then show up suddenly through one of three doors: interest rates, refinancing pressure, or confidence. It's not that the world runs out of money. It's that the cost of money rises, the amount of debt needing refinancing becomes a problem, and investors begin demanding higher compensation to keep lending. Here's the simplest way to picture it. The world is not one borrower. It's millions of borrowers. Governments, corporations, households. They all borrowed heavily during years when money was cheap and rates were low. That was fine as long as refinancing stayed easy. But debt has a timer on it. Bonds mature, loans reset, governments roll over debt. And when rates are higher, rolling over old debt becomes more expensive. That's when the machine starts to strain because the system needs continuous refinancing just to stay stable. This is why the bond market matters so much. Bonds are basically the price of debt. When the bond market is calm, the debt machine hums quietly. When the bond market gets stressed, the machine starts making noise. And when the machine makes noise, governments and central banks face uncomfortable choices, because you can't fix a debt problem with good vibes. You can only fix it with growth, austerity, restructuring, inflation, or some mix of those. None of those options are painless, and markets know it. Now, let me give you a story that makes this feel real, especially if you're in the US. Imagine a government that has to refinance a massive amount of debt every year. It issues new bonds to pay off old bonds, plus it issues more to cover deficits. When rates are low, the interest cost feels manageable. But when rates rise, the interest cost grows and starts competing with everything else in the budget: defense, healthcare, social programs, infrastructure. And once interest costs become a major line item, the situation starts to feel like this. You're taking out a new credit card to pay the minimum payment on the old credit card, and now your interest rate is rising. That's not an instant collapse, but it is a trend that becomes harder to reverse the longer it continues. So when we say the global debt crisis is heating up, we're talking about rising stress in the cost of financing and the ability to refinance smoothly. And you can see that stress through signals: rising yields, weak bond auctions, widening credit spreads, central bank intervention talk, emergency liquidity tools, and the growing gap between what the economy can handle and what debt markets are demanding. Now here's where gold and silver come in, and this is the part most people get backwards. Gold and silver are not just inflation trades, they're also confidence trades. They react to what the system has to do to keep the debt machine running. If policymakers choose tighter policy to fight inflation, that can pressure growth and stress debtors. If they choose easier policy to protect the system, that can protect debtors, but weaken currency purchasing power over time. Either way, the debt problem tends to increase the probability of volatility. And volatility is where gold and silver become interesting. But gold and silver don't always move the moment you expect. In many cycles, the bond market breaks first. Risk assets wobble, the dollar moves in weird ways, and then metals begin their next move when the market starts realizing that the choices ahead are inflationary, destabilizing, or both. That's why this title says, watch gold and silver next. Let's break down the sequence that often happens in debt stress cycles without making dramatic predictions. Step 1, rates rise or stay higher for longer. Step 2, debt servicing becomes heavier. Step 3, cracks appear in parts of the economy that relied on cheap money: real estate, speculative credit, zombie companies, over-leveraged sectors. Step 4, something snaps somewhere and policymakers start talking about support, liquidity backstops, or orderly functioning. Step 5, markets realize support usually means easier conditions at some point, and that's when gold and silver can reprice. The big reason metals matter in a debt-heavy world is simple. Debt is a promise, and promises depend on trust. Trust that the borrower can pay. Trust that the currency will hold value. Trust that the system will stay stable. When debt gets too big, relative to the system's ability to grow out of it, trust becomes fragile. And when trust becomes fragile, people look for assets that aren't someone else's liability. Gold is the classic confidence hedge. Silver is more complicated because it's both monetary and industrial, which makes it more volatile. But that volatility is exactly why silver can shock people when it finally moves. Silver can sit quiet, then move fast once momentum arrives, especially if investors pile in at the same time industrial demand stays firm. Now let's talk about what you should actually watch, because debt crisis is a big phrase, and I want you to have a simple lens, not fear. If you're in the US, you don't need to track every country's debt report to understand the trend. You need to watch the pressure points that show up globally and then spill into US conditions. One pressure point is bond yields, especially real yields. Gold tends to dislike high real yields because real yields offer a safe return that competes with holding a metal that doesn't pay interest. But here's the twist. In a real debt stress phase, yields can become unstable. They can spike on fear, then fall on recession risk, then spike again on supply concerns. That instability is where gold can shine, because gold likes uncertainty and policy stress more than it likes a clean, stable, high-yield world. Another pressure point is the dollar. Many people assume gold always moves opposite the dollar, but in stress events, relationships can get messy. Sometimes the dollar rises because global funding still runs through dollars. Sometimes gold rises anyway because the stress is about confidence, not just FX. The next move in gold often comes when the market starts pricing a shift from tight policy toward protection and liquidity. Gold tends to sniff that out early. For silver, one of the biggest tells is the physical market versus the paper price. In calm times, they track closely. In stress times, premiums can rise, spreads can widen, dealers can go call for pricing, and physical can tighten even when the spot quote looks calm. That's not something you see in every cycle, but when it shows up alongside debt stress, it can signal that people want tangible assets, not just financial exposure. Now let's make it practical. With a simple scenario, imagine we move into a period where economic growth slows, but debt loads are huge and refinancing is heavy. If central banks stay tight, you risk defaults and a credit event. If central banks ease, you risk currency purchasing power and renewed inflation pressure. The market starts to realize there may not be a perfect solution, only trade-offs. In that environment, gold tends to benefit from a policy trap thinking. Well, silver can benefit too, but silver often needs a spark, either a clear risk-on wave, a clear inflation wave, or a clear physical tightness signal that forces repricing. This is where I want to keep you curious, because there's one detail most people miss when they talk about debt crises. The trigger is rarely the total debt number. The trigger is the moment refinancing becomes difficult at scale. It's the moment the market asks, at what rate will we lend, and are we still comfortable doing it? That's why you watch bond auctions, credit spreads, and funding conditions. Debt becomes a crisis when the market demands terms the system can't tolerate for long. Now, what does watch gold and silver next mean in real terms? It means watching for the moment metals stop reacting like a side story and start reacting like a main story. And that shift usually shows up in behavior, not headlines. For gold, watch whether it starts holding up on days when stocks are weak. Watch whether it makes higher lows, even when the dollar is firm. Watch whether dips get bought quickly. Those are signs gold is being accumulated as a hedge, not traded as a short-term bet. For silver, watch whether it stops lagging and starts catching up. Silver often underperforms early, then outperforms late. Watch physical premiums and dealer behavior. Watch the gold to silver ratio. When silver is truly entering a stronger phase, that ratio often starts compressing. Watch whether silver rallies are getting smashed down immediately, or whether they start holding levels. Holding is the difference between noise and a real shift. Now let's address the obvious question. Does a global debt crisis guarantee gold and silver go straight up? No. Metals can be volatile. There can be liquidation waves where everything sells off, including metals, because people need cash. That's actually common in early panic phases. But what matters is what happens after the liquidation, because debt-heavy systems often respond with liquidity. And liquidity is where metals can reprice. In other words, the first move can be messy, but the second move can be the one that changes the long-term chart. That's why you should pay attention to timing. In a debt stress environment, the best moment for metals often isn't when everyone is calm, and it isn't always the exact panic day either. It's when the market realizes the response is coming, and the response will likely involve easier conditions, financial repression, or currency debasement over time. Gold tends to anticipate that moment. Silver tends to accelerate once the crowd understands the moment. Now, let me give you a clean checklist you can use this week without needing a Bloomberg terminal. First, watch U.S. Treasury yields, and whether they're rising because of growth optimism or rising because of financing stress. Second, watch credit spreads. Are lenders getting more nervous? Third, watch the dollar trend, strong, weak, or choppy. Fourth, watch gold's behavior relative to stocks. Does gold act like a hedge again? Fifth, watch silver premiums and dealer spreads. Does physical feel tighter than the quote suggests? If you see yields unstable, credit spreads widening, the dollar acting choppy and gold staying firm, that's often when the debt story is moving from background to foreground. If at the same time physical silver premiums stay stubborn and silver starts holding breakouts, that's when the next move may be starting. Now, here's the part I want you to stick around for, because it's the question that decides whether this becomes a real shift or just another scare. In a world where debt is heavy and refinancing is constant, can policymakers allow a true, sustained tightening cycle without something breaking? If the answer is no, then the long-term bias of the system is toward intervention. And intervention usually means liquidity, backstops, and policies that slowly reduce the real value of debt. That's not a political statement. That's just how heavily indebted systems have historically tried to survive. And if that's the path, then gold and silver aren't just trades. They become thermometers of the policy response. So what should you do as a regular US viewer? The goal is not to panic buy or panic sell. The goal is to stop being surprised. If the debt cycle continues to heat up, you want to understand the signals before the headlines force everyone to care at the same time. The market pays attention late. You don't have to. Now I want to hear from you, because your perspective tells me what follow-up to make. In the comments, tell me what you think is the bigger risk over the next year or two. Inflation coming back, a credit event, or a slow grind where purchasing power keeps leaking? And also, tell me which one you watch more, gold or silver, and why. If you found this useful, share it with one friend who keeps asking why the market feels off lately. The debt story is one of the biggest reasons, and sharing helps more people understand it before it becomes a panic headline. Educational only, not financial advice.